Welcome back to Module 1, Introduction to Real Estate Investing. This lesson is about types of real estate investing. So we have many ways to invest in real estate across all kinds of property types. We can narrow this property type list to the following. We have land. We have 1 to 4 unit residential properties, so single family, duplex, triplex, and 4 unit. We have 5+ unit residential properties, which is better known as apartment buildings. We have mixed-use properties, which is a combination of residential and commercial. Usually you have commercial on a ground floor and residential apartments above that. And then we have pure commercial properties, which have many different categories, but the vast majority are in the following: office, retail, hotel/hospitality, warehouse/industrial, medical, and self-storage. Despite all these property types and all these possibilities, we're almost always talking about 2 types of strategies only. We have the short-term strategy, which is a value add or stabilization activity, and it's going to involve renovating or otherwise improving an underperforming property. This is a faster kind of wealth creation. Then we have the long term, which is buying and holding or refinancing a well-performing property already in good condition right now. This is a slower kind of wealth creation strategy. You can do the hybrid approach, which is combining both the short-term and long-term phases to capture the benefit of both. The most common hybrid approach is indeed the BRRRR process: buying, adding value, refinancing, and holding properties long-term. The vast majority of BRRRR projects are in the 1 to 4 unit residential space, and this is why this area will be the scope and focus of the course. So let's take the types of real estate investing by property type and make a little chart with all the different strategies that are possible. First of all, let's talk about land. Land can be raw or entitled. Both of these are short-term in nature because they're underperforming from an economic standpoint. They're not producing income at this time. So these are only going to be short-term projects until they're developed. Raw land is just like it sounds. It's in its state of nature. Hardly anything has been done to it, and it's not quite ready for building on it. Entitled land is land that's been moved from a raw condition to a partially developed condition and is now ready for actual construction on it. This usually involves things like site grading, parceling or lot splitting, utility work, possibly roads. Certainly, you're having the jurisdictional approvals and permits to get the land entitled. So, looking at these 2 types of land, there are some investing opportunities we can explore. First, you have raw land wholesaling, which is similar to wholesaling houses, as you are acting as a middleman to buy a piece of land from the current owner, who does not really have development plans for it, but there actually might be good demand for it as a piece of land to build a house. So when you have this property, you will also have end buyers, hopefully, that might be interested in the development of land in general, and then specifically this piece of land. And so by contracting it from the seller to the buyer of the property, you would make a flip fee or assignment fee on the land, just like wholesaling houses. The second type of investing for land itself is taking raw land and bringing it into the entitled condition so that it's now ready for construction, as we just talked about. The act of entitling is very important for builders. Builders don't like to take land from raw to entitled because it's not their specialty and it takes a great deal of time and effort. They're really on the hunt for entitled land that's build ready and will pay good money for it. So if you have the skills and the interest to take raw land, do some work on it with things like the engineering studies, permits, the grading, the lot splitting, things like that to get it build ready, then you're going to find buyers who are interested for their construction company or home building company to take that land and start building on it right away. Next, we have the 1 to 4 unit small residential structures. These are going to be short-term in nature for a purchase and rehab type or a new construction type. The difference is, of course, the short-term purchase and rehab is on an existing structure that is run down, distressed, less than optimally performing, whatever reason. It's not in great condition and doesn't have great value, so it's purchased and renovated to bring it up to speed. Short-term new construction is obviously just the construction of a new building on the land. Both of these are going to be moving out of the short-term phase into the long-term phase when the construction or rehab is finished. Depending on the rental type, you could have the long-term rental, which is the normal lease to a long-term tenant who lives there as their personal residence, usually 12-month leases at a time, year after year. Short-term rentals are a whole other topic outside the focus of this course. Short-term rentals have seen quite a huge growth in the last 10 or 15 years. These are Airbnb type properties. These are in certain high demand vacation destinations and resort locations, but actually short-term rentals are all over the place in every city, but it's certainly outside the focus of this course to talk about those strategies. Then we have the larger property types, 5+ unit residential, mixed use, and commercial properties. You can do the same type of strategy in all of these. You have the short-term purchase and rehab of an existing property type in poor condition, low value, renovating it, and then moving it into the long-term rental phase. You have the new construction of any of these property types. Obviously, these types of buildings are being constructed all the time. Then you have the long-term rental stage, which is just the ongoing income on a well-performing property, meaning most units are leased, businesses are operating there year after year. However, these properties do exist in a pretty different financing world. 5+ units, mixed use, and commercial properties are much more demanding from a financial analysis standpoint, and this stands to reason due to the large amounts of money involved. This is where banks are going to focus their property lending activities for the most part. They're going to evaluate your personal financials a lot more, looking at things like income, asset, tax returns, and the like. These are going to require a lot more experience in managing these property types and a lot more investment money to put into the property, hundreds of thousands of dollars at least, if not millions. These larger types of properties can certainly be a destination for many real estate investors later on in their journey. While it may be much more efficient to have larger properties producing income than 20, 30, 40 units of 1 to 4 size, but most investors do keep the 1 to 4 unit focus as they just simply can't get that big or don't want to go in this direction, or simply just don't have the interest or capability to get into these more expensive and more complicated properties. Therefore, for the scope and focus of this course, we are not going to cover these 5+ units, apartment buildings, mixed use, or commercial properties. We will be much more focused on the 1 to 4 unit short-term purchase and rehab phase, followed by the long-term rental phase. This remains the easiest, fastest, and most accessible pathway to real estate ownership. So let's take a short side trip now to talk about other ways to invest in real estate besides the short-term and long-term strategies on the property types we just discussed. Let's say you're not interested in being a short-term rehabber, actively working on distressed properties, trying to restore them to good condition. Also, you're not interested in being a landlord with everything that entails in terms of tenant management, late night maintenance calls, and the like, but you still want to invest in real estate because it's a way to earn money. What other options are out there as alternative ways to participate? So we're going to cover 5 of these now. We have syndications, wholesaling, notes, lending, and REITs. First, we have syndications, which is defined as the pooling of investor funds to acquire large properties with profit shared between the sponsor and passive investors, offering potential high returns but with less liquidity and control. So the real estate syndications are going to be indeed on the large properties. We're talking about things that may be 5, 10, $20 million, apartment units of large sizes, commercial buildings that are very big and expensive, things like that. A lot of investors, most investors don't have access to directly invest in those on their own. So there's a group investment structure like this created. The syndicator or sponsor is going to manage most of the things. They're going to identify the project. They're going to look at the financial returns. They're going to manage the purchasing and ongoing management of the project. They are going to identify the investors and solicit funds and distribute the returns and all that. So the key points are that there is a structure set up usually as a limited partner. The ones investing money are the limited partners. They don't have any responsibility for management at all. They just put the funds in. The general partner will be the one managing the investment as the sponsor. The returns are usually split something like 70 to 80% to the investor pool, and then 20 to 30% for the sponsor person or company. This is going to involve some due diligence required. These are large-scale investments and lots of money involved. So the due diligence is going to be on the sponsor, bringing forth the project, the property, and the market conditions for the property location and such. The issue is here also liquidity. Once you're into these things, it's pretty hard to get out. You can't really sell your shares or withdraw all that easily. So it's pretty much a long-term commitment to be a passive investor in such activities. The minimum investment is also fairly large. These are only open to accredited investors. Typically, accredited investors are going to have something like a $1 million net worth requirement, or alternatively, maybe a $250,000 per year income requirement. So many syndications are only open to such investors, not all, but most. Because of this type of situation, look, the sponsor is going to be looking for investors who can put big chunks of money in, and that means fewer investors on the back end. Therefore, the minimum investment is going to be something like at least $25,000, but more often $50,000 to $100,000 as minimum entry into the syndication. So, in summary, syndications do offer access to large-scale real estate projects for people that otherwise might not have a chance. No direct management involved, purely passive investing activity in real estate. So the next type to cover is wholesaling. This is securing property contracts at a low price and selling them to buyers for a profit without owning the property, offering quick returns with minimal capital. So wholesaling is a short-term investment strategy where the wholesaler is a middle person. They are looking for properties to buy, properties that are in some kind of distress situation, some kind of neglected situation. Sellers are in some rush to sell. Maybe we'll take a lower price. The wholesaler engages in the opportunity to get the contract secured. And then now they're going to turn around with no intention to buy it themselves. They're going to market this property to a group of end buyers. These end buyers are normally real estate rehabbers, the ones that are doing the first step of the BRRRR process, which is the short-term purchase and rehab loan. These individuals are always looking for deal flow, and wholesalers bring a lot of deal flow to these types of investors. So the wholesaler is acting as a facilitator in a way between buyers and sellers that might not otherwise find each other. And I should say these are off-market properties. These are not being listed on any type of multiple listing service. So lots of times these are very informal. These are not well popularized and marketed other than the wholesalers doing such. So it is a facilitation between two groups of people that need to talk to each other with a property in the middle to be sold here. So the process is indeed to identify a distressed or undervalued property, negotiate the good price on the purchase contract, and then indeed find the end buyer willing to pay a higher price and pocket the difference. This is going to be known as the assignment fee. Ownership, again, the wholesaler has no intention of taking ownership of the property and doing the rehab themselves. So they don't have much in terms of capital contributions or financial risk. The only money they really need is to run this type of business for engaging in the marketing to get the properties under contract and assigned to a buyer. Lots of real estate investors start in wholesaling as a way to start out and get some capital. Wholesaling is a very quick type of transaction. Most of these are resulting in hard money type loans with 5 or 10-day closings. So also the assignment fees can be on the order of 5 or 10,000 on the low end, possibly 20, 30, 40,000 or more. So you can see that doing 10 or 20 deals per year without much of a capital investment by the wholesaler is a way to generate a lot of money. And not every wholesaler indeed ever moves to real estate investing to own the property. Some do, but many just remain wholesalers and simplify their life in terms of just taking the fee, and then the property is taken away by the buyer and they never have to work on the property at all. So it's important to make sure that you understand the requirements to run this type of business. It's a very active type of real estate investing in terms of being on the lookout for properties all the time to get under contract, and then engaging and keeping relationships with buyers to market those properties and get a deal done against a lot of time deadlines normally. So indeed, wholesaling is an attractive strategy for newer investors who are looking to generate quick profits with a small amount of capital investment, if any. It does require a lot of negotiation skills for the contract price, market knowledge as to what something might be worth to a rehabber, and then definitely keeping constant access to a large supply of properties and also a large number of potential buyers looking for those properties. Next, we will cover notes. Notes are the buying and holding of existing debt instruments to generate passive income through interest payments secured by property with potential risk like borrower default and lower liquidity. So, notes are indeed involved in buying an existing debt instrument. These are mortgage notes that a lender has written to a borrower, and now the lender is looking to get that capital back. So they're going to sell the note for a certain value, and therefore the interest payments from the loan payments from the borrower are going to be redirected from the lender now to the buyer of the note. So the note buyer is going to buy this income, so to speak. These are very passive, other than finding the notes for sale out there. There are some hard money lenders that, and other private type lenders as well, that will offer notes for sale and the like. They are not easily sold. Once you have them, there is a limited market. These markets are usually local in nature. The lender and the borrower and the note buyer, usually it's in a small local city. They're not going too far away, because it's important to know the details on the property values. And in fact, the borrower itself is nice for the note buyer to know, and this is possible. So notes can be two types. They can be performing, which means the borrower is current on the payments and it's steady, reliable income every month. They also can be non-performing, which means the borrower is behind on the payments. These are going to be discounted, so they can offer higher returns, but definitely higher risk. If the borrower decides to stop paying, there's potentially a foreclosure in the future for something like this. So the security is, of course, the real estate collateral. That's going to provide a layer of protection for the owner of the note. The risk are just going to be, of course, the borrower stops paying, and the legal issues with potentially foreclosing on the property. So for any note buyer, it's important to kind of be local to the area, knowing the borrower, and evaluating their credit worthiness, the history of payments and the like, knowing the property and the neighborhood and the market value, definitely the terms of the notes and the stuff. But the main point is these are easy way to buy income, invest your money in buying a note, get regular interest payments. Need to do a little bit of activity to find the notes and maintain the notes, but it is pretty passive, and it is a source of income without actually owning the property. Next, we'll cover lending. This is providing loans to borrowers who are real estate investors with the expectation of a return on investment. So if you have money that is idle or is not making the returns that you might like, the opportunity to provide loans to borrowers is always out there. Borrowers who are real estate investors are always searching for funding. Private lenders are going to be very informal. You're going to be able to negotiate the terms, decide for yourself if you want to engage in the lending of your money for the borrower. So you're going to evaluate the borrower, the property itself, and the like, and see if it's worth your risk to do it. The risk is mitigated by having the property as collateral. So the security of the property is very helpful. Interest rates and other terms are completely flexible and up to you. Borrowers who are entering this market have the choice of many private lenders, which is what you would be here with a lending activity. Hard money lending is a more formal business type of lending where it's more about qualifications and relationships. We have a whole section on this later in the course, the difference between private lenders and hard money. This is very important. This is a hard money course, and so identifying what hard money lending is in contrast to private lending is important. But anyway, private lending is an informal way to make a return on your investment. This can be done from your cash savings. This also can be done from retirement accounts. We also have a topic to cover in a later lesson for using real estate investments using retirement accounts for your real estate investments. And finally, this type of lending is going to be somewhat passive. You are going to have to meet borrowers out there. Typically, this can be done at real estate investor events in your local area. You're going to find borrowers who are looking for access to easier funds like this without qualifying so much with another type of business that may be stricter. You can negotiate the terms freely with the borrower. And then when the loan comes in, the passive nature of the income coming in is great. You will have to manage it if there are any late payments or any trouble on the property. And also, these are generally short-term loans at higher interest rates. You can make 10 to 15% interest by loaning this out on the short-term purchase and rehab phase. Long-term investments for rental properties being 30 years or more. Most private lenders want to recycle their money a little faster and make a higher return. So typical terms on this would be something like 6 to 24 months. So you're going to have to recycle your money, potentially have 1, 2, 5, or 10 loans out there at one time. When one is paid off, there is going to be a need to find other investors and the like. And it can be as busy or as big as you want it to be with how much money you want to put into the lending world for real estate investing. But there is a degree of activity there that's not entirely passive because you're running the operation and have to find the people to lend the money to. Finally, we have REITs, or real estate investment trusts. These are a way to access and invest in a diversified portfolio of income producing real estate, offering regular dividends and liquidity through publicly traded shares of the real estate investment trust. So here are a few stock tickers. I will let you look those up and see what types of properties they have. The key points to cover for the REITs are that these are indeed traded on major stock exchanges, so they're going to be exactly like a stock. You can buy and sell these every day. They do fluctuate in value, and they are very liquid, so of course you have ways to buy and sell these very quickly. The good news for income-minded folks is that the requirement for a REIT is to pay out 90% or more of taxable income to shareholders as dividends. So these are going to offer very nice dividend returns and dividend payments periodically to the owners of the real estate investment trust as a security. So there are various types of REITs. There are different types of properties that they own. Some are going to be in office. Some of them are going to be in shopping centers. Some of these are going to be in data centers, cell towers, medical hospital type buildings, casinos, and the like. So as many types of properties there are many types of real estate investment trusts owning such properties and available for purchase on a stock exchange. The great news is these are going to be heavily diversified. So each of these companies is going to own dozens, if not hundreds, of properties within their type. And so you're going to have a great deal of diversification, and you're going to have a lesser risk compared to investing in individual properties. If they have 1 or 2 properties that go wrong in a year, that might be normal and not detrimental to the total income. If you have a few properties and one of them goes bad, then that's going to be a much bigger deal. So this is a lot less risk, more diversification, highly liquid investment that is going to be easily bought and sold if you would like. So REITs provide an easy way to invest in real estate with this type of liquidity and diversification. So definitely a popular choice for income-oriented investors who want to have a totally passive way to invest in real estate. Okay, so let's finish this lesson. We have our chart here again showing all the different property types and strategies within those types. We will have to exclude everything in yellow here on this chart because they're outside the scope and focus of this course. This course will be tightly focused on the BRRRR process, and what remains here is the short-term purchase and rehab phase, followed by the long-term rental phase. These are the 2 steps in the BRRRR process. I will have one more lesson next with a little more detail about the scope and focus